All right, today I want to go over a couple of mortgage discretionary issues that I've noticed been causing loans to die in underwriting. One of them is a very common scenario. Discretion in this regard isn't brought up that often. The other is a much less common scenario that when it does come up, I'm finding a lot of loan officers aren't prepared to deal with it. So the first issue is when you have someone, typically a first-time home buyer, who has been renting their home or renting their apartment. Uh, and when the file gets into underwriting, they are requested to show their lease to see if, in fact, they're coming near the end of the lease. And if they aren't, is there a penalty for breaking the lease? So if you have somebody with 4 months left on a lease and they're not able to get a letter from the landlord saying that they'll excuse them from having to make the further rental payments, the underwriter can require those 4 months of lease payments to be deducted from qualifying assets, which for a lot of first-time home buyers is going to cause the loan to die because they don't have an additional 4 months of reserves to deduct from their available funds. Now, this is a condition that has come up only occasionally through the years, but I am seeing it now more often. I was concerned that it could start to come up more frequently now with Fannie and Freddie and FHA having the ability to add a rental history to the borrower's credit report to help in those cases when it's needed to get an approval. I've been concerned that even though those rental payments are going to be something that's calculated based on seeing the monthly withdrawals from their bank statements, that some underwriters then may be prompted to ask for a verification of rental form. And if that form comes back and says, yeah, they've paid on time, but they have a lease obligation still, that can be something that can trigger the condition. So be on the lookout. If you're working in a retail setting, you have only one underwriter available to you, it's good to know in advance how is that underwriter going to handle the topic. If you're operating more in a broker setting where you have access to various lenders, you're not sure which underwriter you're going to get when you submit the loan, it's good to check with your account executive up front and see how their company is going to handle this situation. Is it ever going to come up? Or is it only going to come up in certain situations, such as one time recently, the applicant had been living in their current residence only for 6 months. And that seemed to trigger the underwriter requesting the lease. It doesn't really make a lot of sense because somebody had been living in a place for 2.5 years. Now, some people after the first lease may go month to month, but it's much more common that a lease renewal is signed every year. So someone who's been in a place for 6 months versus 2.5 months, either one could be at risk for owing that amount of money or not being able to get out of the lease without paying money. So if you want to find out before you submit the loan overall what the situation is, you don't want to be calling it out necessarily when the situation is on your file, because then you are alerting the underwriter to an issue. Now, I don't think in any way that this somebody can say, well, you're hiding something from the underwriter, you should tell them, because this is a condition. It still comes up very infrequently and really with no rhyme or reason. So to know up front, especially now when loans are so hard to come by, I know a lot of our customers are newer to the industry. They've been working for many months to try to get a realtor to send them a loan. And we want to try to think of every possible issue that could come up front, so we don't ruin that realtor relationship. I mean, it can happen to anyone. It doesn't have to just be somebody new. You can be an experienced loan officer and not realize that this is a possible topic because you can have gone years and never had it be raised. Okay, so now I'm going to move on to the second topic that we've noticed causing some problems lately. And that is when the applicant, your prospective borrower, receives a K-1 for a share of business income. We know this could be from an S-Corp, partnership, could be an LLC taxed as an S-Corp or a partnership, and they receive a K-1 that has the income. And the issue that most loan officers are aware of, some of the newer folks might not be, is that their share of the income that's earned isn't always distributed to them. So the K-1 will show how much was earned and how much was distributed. And if the full amount wasn't distributed, then there is typically a liquidity test of one sort or another. I'm not going to, on this video, get into the different types of liquidity tests, how they're calculated. But essentially what they are is a way to look at the corporate balance sheet, either through a tax return or a current balance sheet, to see if the company had the liquidity, had the money on hand to distribute it if they wanted to, or if they didn't distribute the money because they simply didn't have it. And the logic behind that is that the owners, if they needed the money personally, they could have taken it. And at least at the snapshot in time, when we're looking at the liquidity, it could be taken after the fact. So it wasn't distributed in the tax year, but it's available to be taken now. So a situation could be $200,000 was earned, but only $100,000 was distributed. Now the taxes are owed on $200,000. That $100,000, most, if not all of that, might have been needed to cover your state and your local income taxes. But the owner of the entity knew that they were okay personally. Their liquidity was okay personally. They didn't need to have money left over during that tax year from the entity in order to be able to handle their day-to-day expenses. And if the liquidity's there, then underwriting goes along and says, okay, we'll let you qualify using the full 200 because we know you could take it if you decided that you were no longer going to use that money within the business for some expansion and you were going to take it personally. But where the problem has more recently, I've seen it a couple of times, is when the borrower only has a minority interest in the entity. And with a minority interest, they don't have the control that even if the entity does have liquidity to say, okay, give me the money now, I need it. And where this is coming up is especially if a large portion of their income is on that K-1 that was earned but not distributed. So you're seeing underwriters looking at how much of that income is related to that entity, what percentage. If that's only 5 or 10% of their income and the liquidity is there, things are going to probably be fine. But if that's half of their income, and even if the liquidity is there, the underwriter is concerned that they not may be able to get it if they need it. So what's happening is further delving into the situation. Prior years, was the income distributed when it was earned? Asking for a letter from the majority owner. Was this a one-off? Do you expect going forward that you will be distributing the money that was earned? So those are two areas to be concerned about. I'm Alan Berkovitz, the Complete 1003 Software. We both train newer loan officers to send only 1 or 2 touch files into underwriting. We also have a supplemental mortgage application software that allows a loan officer, again, more often than not, it's newer ones, although we know that there are some who have been in the business for a while that tend to forget to ask things they know they should ask. So if you're interested, either personally or corporately, in reducing your underwriting touches, reducing what I call lender cause fallout, we can't help it if the borrower's property doesn't appraise. We can't help it if the borrower quits their job before closing. We can't help it if the borrower messes up their credit before closing. But we all know there is a lot of what I call, again, the lender cause fallout. And if you're looking for a solution, especially for your newer loan officers, to minimize or remove it entirely, I'm going to put up on the screen here. This is my first live. I'm not sure that I'm going to be able to find it. I'm going to share the screen here, and I'm going to now show you how to get in touch with me. You can check us out at thecomplete1003.com, or you can email me, Alan, at thecomplete1003.com, and I'd be more than happy to talk to you about the services that we offer. So that'll be it for today, and good luck out there. I know it's a tough market.